Welcome to the ARMR Report. It's a Saturday. We're doing the week in review. I appreciate you all being here to join. We're going to try to rip through. We have a lot to unpack. So here's how the breakdown is going to go. We're going to look at the big indexes first. The ARMR investing way is to really follow a three-step process to help us get rid of all the noise around us, all the stuff on YouTube, CNBC, all those things, and just figure out how to make money and protect capital. That's it. Okay. Simple three-stage process. We build our whiteboard. That's fundamental analysis, things that we want to own. We use ARMR algorithms to tell us when to buy stocks. Algorithms for big indexes, ETFs of groups, and then individual stock algos. All the way down to day trading algorithms for those of you who are part of the ARMR Live trading desk in the morning. Okay, so we're going to look at that and figure out what's the market telling us next. And I titled this discussion today, "There's a Williwaw out there, and I just don't know when it's going to hit the market, and how do we prepare?" Okay, I'll explain that in a minute. Then we're going to dive into a quick look at some ETFs of groups. It's very interesting, and I think it will help you manage your own portfolio if you look at the big picture of group movement and then dive into the stocks themselves. So the hierarchy is, what's the market doing? The indexes and the big indexes. What are the groups doing? What are the stocks in there that are leading? That's how you want to invest, because that's how institutions invest. That's where the big money, that's how the big money is run, right? So we're the cheetahs that are running between the legs of elephants, on the Serengeti. That's what we're trying to do. We don't want to get stomped on. We want to be out ahead. We want to get to the watering hole before they do. Okay. So you want to follow that path. So we're going to look at some ETFs and see, what is it telling us about the market? Can we glean any information? Then we're going to go into top stocks to watch and buy next week. Okay, these are things that the ARMR Report will look at, some of the patterns and stocks that we bought over the last couple weeks, so you could see what we're doing. And then how do we take that success and apply it to stocks next week? And what are the top ones we're looking at? And as a bonus track, I want to talk about the Cannabis Couch again. I want to all sit down on the Cannabis Couch and go over what's happening right now and discuss the silver lining, okay? There's a silver lining in the weakness right now, and it's going to be big. And so I'm going to share that with you. Then I'll get to Q&A as always. So don't forget, I'm sharing with you a strategy that I've built over 30 years of running money personally and professionally. I don't know your risk tolerance. I don't know your goals. You have to figure that out yourself. So I'm not telling you what stocks to buy. I'm sharing with you how we put capital to work, how we protect capital. Okay, the ARMR investing way is a more of a stair-step approach to investing when it comes to net worth creation. We're not looking for the skyrocket and collapse in net worth. What we want to see are stair steps higher over time. So we capture upside when it's there for us. And then there'll be periods of time where we're playing defense and protecting capital, where you see kind of bottoming out or sideways action in net worth. And then you have the whole next step up. And what we avoid are the huge potholes of market implosions that destroy confidence, destroy net worth, okay, and make it difficult and sometimes burn people out and they don't want to invest anymore. All right, so try to put that aside. This is what we're doing today. So let's hop right in. First thing we want to do, of course, you can always subscribe down here if you want. I've got that set up for you. ARMR Insiders, you pop on, you go into the ARMR Insider and you're going to find all the different things we're talking about throughout the day. So consider investing in some time and some camaraderie, and join us on the trading desk. We're sharing information all day in our Slack room, stocks we're buying, how to trade, all those types of things. All right. So having said all that, let's dive into a look at the indexes. So first of all, what we're looking at is an index of the NASDAQ 100. So ARMR index-only portfolio's got 130% exposure. We've built up our exposure since right around in here when the market started to take off again, okay? And there's nothing wrong. So we're just doing a quick check of the indexes. Nothing wrong with the NASDAQ 100. Looks like it wants to skyrocket again next week, All right, the Dow took off last week of this nice pattern. We added the Dow to our index-only portfolio right here. Okay, and so now it's starting to step out. It looks great. The biggest and most important index, of course, is the S&P 500, and it's just in a melt-up phase. So why, when we look at these indexes, why would I title today's track, "There's a Williwaw out there, how do we prepare for it?" First of all, a Williwaw, kind of a fun word to say. You guys can look it up and read about it. But it's about wind, okay? And so if you're in a sailboat, you're cruising, whatever, and you drop anchor right next to a huge cliff face, okay? Huge mountain right above you, and you're dropping anchor right below it. Sometimes the wind pattern will collect wind at the top of that mountain, rip it down the mountain, and smack right into the side of your sailboat and completely lay it over in the water. Okay, and you really never know when that's going to happen. So how do you prepare for that? Well, for one thing, you don't have to anchor next to a huge mountain, but sometimes you do, depending on an anchorage. And so this is what I think the market has to be concerned about. You're on a sailboat. It's gorgeous. You're in some beautiful anchorage. You're next to these huge mountains that are gorgeous. The ocean, Pacific Ocean is maybe out there, and this life is just the greatest. That's what the market is right now. We're just grinding higher every day. Big indexes are going up. Yeah, there's some real ugliness. I'll get to that chart in a minute. That's kind of hollowing out the market inside. There are some breakdowns of some quality names that are getting destroyed. There's more and more capital focusing on fewer and fewer names. These are all concerns that I have. And I spoke to you a couple of weeks ago about the wall of worry that the market is climbing. My wall of worry keeps climbing it. So what creates the wall of worries gets real huge, and then a Williwaw comes flying down that wall and lays over the boat. And what we want to try to figure out is, how do we protect ourselves from that type of action that it's almost impossible to predict when it starts. You just don't know. So on the one hand, you could say, I don't care. I know some of you out there just don't care. Okay, market will drop 10% in a week and stocks will get destroyed, and you'll just live through that. But for me, I try to protect my capital, right? So when I see this slow grind higher, this volatility compression, okay, what do we mean by that? If you look at volatility, VIX, okay, it's just straight down on VIX. I mean, just straight down. And it's just going to new lows as we speak, okay? The VIX index, day after day after day. Take a look at what's happening right in here and ask yourself, how many times does this happen? 1, 2, 3, 4, 5, 6, 7, 8 days in a row, straight down. I guess what was 1, 2, 3, 4, 5, 6 right here before you had a blip higher. Okay. This is just an extreme compression. And yet there's other things going on in the options market that make it seem as if some important institutional money is setting up some hedges going into Jackson Hole. Now, I don't know if Jackson Hole is going to be the reason the market goes down. Probably won't be. Okay. People, remember Ben Bernanke blowing the market up in 2015 at Jackson Hole, and they think, oh, that's when it's going to happen now. It doesn't work like that. The Fed remembers that too. So, I mean, is the Fed really going to come out and say something horrific at Jackson Hole? Probably not. But to wrap up this, we have a lot to get through. So I'm just going to finish my thought with this. There's a Williwaw out there somewhere. When you grind higher like this and volatility gets compressed to such an incredible degree, somewhere out there, there's a rip higher, okay, in volatility. And the market's going to take it on the chin. So, when should I care about it, and what am I going to do about it? Well, the reason that I care about it is that my favorite leading indexes, okay, let's look at the ARK Innovator. Hasn't broken down yet. We have a position on innovators in our index-only portfolio that I'm continuing to build. So if it holds here and reverses, that'll be great. That'll take some of my concern away for the market, and I'll be adding to the position there, okay? Same thing with the fintech. So there's some of the innovators are still tight in a pennant. And what I want to see them do is join the rest of the market. Right now, what's happening is money is leaving those names and focusing more and more on big names like Apple, which looks great, by the way. And this is part of the ARMR portfolio. We bought Apple down here. Okay. So Apple's run up, made a high tight pennant. You could probably double your Apple position as it breaks out again, because money is funneling into fewer and fewer names. We own Microsoft down here, actually. Okay. Microsoft keeps charging higher, and there's a bunch of names like that. But what really concerns me is this chart right here. This is the Russell 2000. These are the small cap stocks. Now, I've been saying this for a while, right? And here's the funny thing about it really doesn't do me any good to come out here and have this conversation with you. Okay. It really doesn't do me any good to have this conversation, because the market usually goes up most of the time, and who needs to bother worrying about the market going down? I know some of you feel that way. All right, but I protect my capital. I don't get stuck in markets that implode and just pretend that the government will bail me out, right? So I'm always looking for, when do I have to protect against a Williwaw? When I have full exposure in the market, market's grinding higher, volatility has gone down every day for 8 days. What are the signs? And this is what I would share with you right now. What are the signs we have to look for that would get us to begin to build the ARK, right? There's no point in building an ARK when it's already raining. So what kind of ARK we're going to build, and when do we start? And the first thing I would say to you is, if the small cap index continues to underperform, we have a double top, a rally back up to the 50, and a rolling over. Now, look, if this thing blows out next week, takes out the high of, what is that, the 6th of August, then that's great. And I'm not, that would reduce my concern about the market. Okay. But until then, what we have forming is a real negative divergence between small caps and the big indexes. The reason that's important is that almost every major decline that I can remember begins with weakness in small caps. Because institutions think like I'm sharing with you right now, and they begin building their ARK early. And what they do to build their ARK is hide their money. And I'm going to show you where they're hiding it in a minute, looking at group ETFs. They're going to hide their money in a couple of group ETFs. They're going to hide their money in Google and Microsoft and Apple, because they're very liquid. So it's easier to control the risk. And they're going to sell first all of their small cap names, a lot of their innovator names, too much volatility, too risk. They're building the ARK. And how do we know they're building it? It's because we could see this negative divergence. The NASDAQ's up here. The S&P's up here. The Dow's breaking out. Small caps are breaking down. Okay. So the first thing we could do if we choose to build an ARK is to buy protection on the small cap index. Even if my whole portfolio is big cap, which it is right now. In fact, not just even, because it is. What I'll be doing is buying index puts on the small cap index as a hedge for protection. I'm not telling you to do it. I'm telling you that's what I'm doing. And I'll be laying that position on over the next couple of trading sessions, maybe the next couple of weeks, depending on how the market behaves. But I'm going to be building the position. I started Friday. What you have to understand when you're hedging is you don't care if you lose the money. It's insurance. You hope you never need it. My whole portfolio will go up if I don't need it. But if the Williwaw hits, that part of my portfolio makes a lot of money. And even more importantly, from an emotional standpoint, it makes it easier to execute the rest of your strategy when you're making money over here, realizing you did something important and correct to protect yourself. Or if you don't want to use stop losses in the rest of your portfolio, at least you're making money over here to make up for the massive losses that you're experiencing, and you're just not willing to admit it. And so you're okay, the market's imploding. At least I'm making money over here, and you could book that short-term profit, and it helps you manage your longer-term goals if that's what you're trying to do. So I'm not telling you to buy puts. I'm not telling you to trade options. You have to decide that for yourself. Risk tolerance, yada, yada. It's up to you. But this is how I begin. I look at small caps. I take small cap hedges. I put them on. Happy to lose money on them. If the market starts imploding, the money that I'll make in a small cap hedge will be exponential compared to a big cap name breaking down. And so that's why I use that. I'm not really buying volatility. It's almost impossible to make money buying VIX and VIX related assets. Look at the downtrend. So you have to be so perfect, catch it just right. But I want to bring up VIX because time and again, and this is the most important thing, write it down, and I'm going to move on now. Write this down. Watch VIX. This is the key. You're going to find this is going to happen, and you're going to watch it happen, and you're going to be like, what's going on? I don't get it. And then it's going to unfold. So I'm going to share it with you right now. This is important. There will be a time in this grinding higher bull market where the market has a couple of days where it rips higher. Like it's grinding, and all of a sudden it's up 1%, up 2%, bang, bang, like this. And at the very same time, VIX is going up with it. And that's when you're right around the corner from the market imploding. I've seen it happen over and over and over again. So watch VIX. And this is interesting. I'm going to just show you the screen. Okay. So VIX was down literally every day for 8 days. Right? And then on Friday, it was blue. Popped up blue on Friday. NASDAQ was up 1/3%. The S&P was up a tiny fraction. VIX popped up. What we're looking for is for the market to have a strong up morning. Let's say Monday morning, market gaps up. Hey, everyone's excited, new all-time new highs. And VIX goes up with it. That's what you're looking for. It can happen for a day or two. But it's almost always the beginning of the sell-off. Volatility going up with the market is never a good thing. And it's a great lead indicator along with your small cap index. Use those two as a guide. Look, we're over 100% exposed to the market in the index-only portfolio. So I'm not calling a bear market. I'm just saying there's signs that are starting to form. And when you see it happen, already have your game plan ready so you can protect yourself. Those are my thoughts. All right, let's move on to Group ETFs. I want to share XLU with you. I've shared this with you over the last couple of weeks. I said to you, this is an unreal chart pattern, a pennant with a cup and handle in it. We were buying it right in here. Hopefully some of you all join me on this. Okay. So what we're doing is locking in a yield of around 4%. Anywhere between 3 and 4%, depending on the asset. And the thing is walking up. Take a look at this index. This is a nice, tight pennant formation, right? It looks like it's in the process of about to break out. This is the pharmaceutical index. I'll just share with you some stocks that are in the ARMR portfolio and have been for a while, right? We have this beautiful bottoming pattern in Gilead. I don't care what you think about the company fundamentally. It's a 4+% yield down here. Everybody knows a remdesivir didn't work, blah, 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 all this stuff. They got tons of cash in the balance sheet. They're paying it out in a dividend. They're making some key acquisitions. The stock's breaking out. But Johnson & Johnson. Oh, base on top of a base. I think we talked about that 2 weeks ago. We were adding this to ARMR portfolios. Now J&J's breaking out. Of course, the all-time most beautiful pharmaceutical is Pfizer, which I shared with you right here. We were buying that in the ARMR portfolios. And of course, it's just skyrocketing. And we own this thing with a yield of 4%. That is the proverbial cake and eating it at the same time, having it and eating it. Now you look at those groups and the stocks inside those groups, utilities. I mean, we own, for instance, Duke in ARMR portfolios, right? And this Duke was down here on the screen, but that's actually the dividend it paid, right? So it paid a dividend. So you see the price go down X dividend, right? So Duke is running. Southern Company's running. These are over 4% yields. Okay? If I had more room for utilities, I think Dominion looks good. I don't own it, but look at Dominion. Look at Dominion's setup. It's a 3.5% yield. Meanwhile, the innovator funds, and the, let's see, like ARKG. Let's take a peek at that, right? So ARKG is breaking down, which is genomic revolution. So things that are on the cutting edge are breaking down. Meanwhile, utilities and pharmaceuticals are breaking out. That's a market that is typically a market where big institutions are hiding money. I really can't even explain to you. We talked about this last week. I don't understand how XLF can do this and utilities can be breaking out. Something has to give. Either financials are going to implode or utilities are going to stop going up. I don't know which. It's so rare that you see both go up at the same time. So I don't know what's going to be said at Jackson Hole. But what the market's telling you is that interest rates aren't going up a lot anytime soon. That's what the market's telling you. Because pharmaceuticals, there's two reasons to own them. They all pay dividends of somewhere around 4%. When we were, not anymore when we were buying them. Now they're up a lot, right? But 4% yields there, 4% yields in utilities, and they're all going up now in principal. So that tells you interest rates aren't going anywhere on the upside. Here's an idea. You can jot this down. We added it on Friday. I've just been waiting. I've been waiting to add ABBV to the portfolio. 4.5% yield. Earnings came out. We didn't want to own it in front of earnings. It sold off on earnings, came right down to the uptrend, and then gave us our risk on buy signal using our ARMR algo. Okay? Our individual stock algo. So this is really an easy position to put on for me. We're leaning into what's been working, right? We're making money on all of our pharmaceutical stocks. Why not lean into it and keep collecting yield? Okay? So we've got ABBV right in here with a stop. The stop is so simple. It's like I take out these lows right here where I'll take the position out. Okay. Risk minimal. Reward, if it continues to behave like all the other pharmaceuticals, is to have the stock go up and collect a 4.5% yield. It's a different market than we're used to, but one that we can have a lot of fun with. And honestly, it's easier to sleep at night. It's just a lot less volatility, right? So these type of names, my portfolio is not going to jump 1% and 2% a day. But if I can grind out 1/3%, 0.75%, you know, I'll take it. Meanwhile, I'm collecting dividends like this. All right. So what are these ETFs telling us? It looks like somebody with a lot of money is piling into the type of stocks that are the best ones to own during a Williwaw. That's my thought. What's the trigger? Watch VIX when the market's going up. If you see VIX running up with the market going up, it's time to batten down the hatches. All right. Moving on. Let's do a quick chart chat. I want to go over some of the stocks. I've showed you the stocks that we already own. Let's go look at a couple names at the top of our whiteboard. You can write these down, do some research on your own for next week. Here are a couple of thoughts for you. Disney. We added a half a position in Disney before the earnings announcement. We're going to be looking to double our Disney position if it holds above these levels. It had a blowout earnings number all across the board. I was kind of disappointed, truth be told, in this action all day. So this is an intraday chart you're looking at now. So it gapped up and just sold off all day. All right. Sometimes the stock will do that and close the gap. So the key is, does it stay above really the ARMR moving average, this yellow line? And we'll be watching that closely. And if we can get a setup, now typically what I look for on after a gap up is day 4 after the gap up. There's really, to me, a 3-day rule. You get the gap up, then the asset will consolidate for 3 days within that usual range. And then day 4 tells you direction. It either breaks out day 4 or it breaks down. It doesn't always happen that way. This is Kentucky windage, but this works for me, right? So I'll be looking to see if a bottom sets up over the first couple days of next week. And if it does, I'll double that position because I really like what's going on at Disney. And I thought that earnings announcement was pretty solid. I continue to buy yielding plays. I have a half position on LUMN. Okay, if LUMN ever takes out the high of the big down bar, which was earnings, I'm going to double that position. If it takes out these lows, I'll exit the position. Okay. The reason I'm taking a half position here, right in here, it's an 8% yield. Okay. And I'll double if it breaks out. If it breaks out, it'll tell you that what I'm about to say, the street is starting to believe. So the company announced earnings. The company stated, just so you understand why the stock has been going up. It's a telecommunications company. The stock has been going up because they pay a fat dividend and they've been paying down debt for the last couple of years, refinancing. The dividend is solid. They've been increasing the dividend, stock buybacks, whatever. So it's been a story for a conservative investor that says the dividend is safe and we're going to divest of all the types of businesses that are, are cash drains and focus on the cash cow. So that attracts a certain type of investor. What they said on the last conference call is we see a growth opportunity. The dividend coverage ratio is going to change. The amount of cash we have to cover our dividends is going to be less. We're not going to focus on paying down any more debt right now. We want to go after this growth opportunity, and we think the dividend can survive that. They're not looking at cutting the dividend. They might not be increasing it aggressively, but they authorized a $1 billion stock buyback program. So the board and management thinks there's a growth opportunity for the company. It's paying 8%. They might come out and cut the dividend. Stock will be down that day. It could happen. On that conference call, management didn't give us any indication that would happen anytime soon. Could it happen a year from now? Maybe. Okay, great. I'll collect my 8% because I think the stock is going to start moving higher if the fundamentals play out that management believes. And that story that I just shared with you, we'll know if the street believes that or not if it takes out the high of the big down bar. This big down bar was earnings and panic on the news, all right? If it takes out that area on the upside and goes back above the 200-day moving average, then we know we have a fish on the line. All right, so I got a half position size on. No big deal if it breaks down, I'll get out. But if it breaks out next week, I'm going to double it. Okay? Now here's an idea for you. I got the whole craze here of electronic bikes, EVs. This is a new idea. One of the ways a company gets onto my whiteboard when I start to do research on a company, many different reasons. I look for turnaround stories, but typically I look for something new that's happening inside the company. What's new that's happening? So you take an older company that has solid balance sheet, decent business, kind of following a path, and then they introduce something new that brings in a whole new wave of customers, and you get a run like this. All right, I'll give you an example. We did research earlier in the year on Levi's, and we've been talking about it for a while now. Okay, Levi's changed the face of their business dramatically, right? And down here was the beginning of this move. And they keep blowing out earnings because they have kind of refocused how they do business. So it's an old school name that's attracting the younger crowd, and the stock has been phenomenal. I wonder if we should all put Hog on the list. Harley Davidson. Is it time for Harley Davidson? They have released an e-bike that looks pretty cool, and it's starting to go multinational. And I have to do some research. I'm going to listen to some conference calls, but that is definitely the entry point from a technical standpoint. Harley Davidson's right on the uptrend, right on the 200-day moving average, right on top of support, that yellow line. Okay. If it stays above it, this is the entry point here. And if the new product is a reason to draw people to the store, it may not be. I could be totally off. I'm just sharing with you my thoughts. This is how something gets to my whiteboard. Something new occurs inside a company that makes it more relevant again. Okay. You put that on top of econ reopening, all these different things that are going on. These type of stocks are working. So the group itself is working. And then I come across the Harley Davidson story and I start to get interested. I have a soft spot for Harley Davidson because it was one of the first stocks I ever bought in 10th grade of high school when I first opened my equity account and made money. So it's always, I have a soft spot. But anyway, doing work on Hog, I think that looks interesting. Tesla. At some point, we all have to recognize that there's a massive amount of open interest up here at 1,000. And that is an unbelievable magnet. Okay, so that chart pattern, everybody sees that pattern. The question is it going to rip up here to 1,000? I love the pattern. The day trading on this thing is just beautiful. I mean, there's no reason to ever miss a day trade on Tesla. It's so obvious when it sets up. Okay, so we're going to be all over this next week. And the object is to get on a day trade that works and then hold it on its move up towards 1,000, in my opinion. Let's run up through a couple more names. Top of my whiteboard is always MGA, okay? Magna is the company that makes the drive trains that go in most of the electronic vehicles that you are buying, okay? I've been waiting to buy the stock. I've been patient. It's come right down to the 200-day. We're long MGA now. Okay. We're trying to find chart patterns, that look like, this. I don't know if I shared Chubb with you, but we added shares of Chubb to the portfolio right in here, I guess a couple weeks ago. This is the pattern we're looking for. And so you can see why, when I show you something like Hog, it interests me. So what I'm looking for is a pattern right on top of old support that goes back a long time, right? And then buying tight to the base. So we're not paying up for it as it breaks out. We buy Chubb down here. So just to look at Hog again. So what Hog has done is it broke out, pulled right back to the old base, going way back to, what is this, 2019, right? Sets up its pattern. And then look at MGA. It's kind of the same idea. Okay? Right down to the bottom of its pattern, and we're buying that right there in the base. I couldn't help myself. I had to buy Altria last week. That chart is sick. 7.3% yield? That's just a no-brainer to me. The risk reward there is a no-brainer. So we added this position right in here, and it popped up. It's moving higher. We're making money in it. And, of course, the stop is the lows right in here. Pretty obvious, okay? So those are some of the names that we're adding to the portfolio, or we may add next week for you guys to pay attention to and take a look at for yourselves. So let's just hop onto the Cannabis Couch, all of us together for a second, then I'll get to Q&A. So the most important thing to realize is I don't have an axe to grind here, okay? We don't own cannabis stocks. We're not losing a penny in the sell-off in cannabis stocks. Hopefully none of you guys that have joined us on the trading desk are losing money. I mean, we made money the last time we traded cannabis names, so we're out. So this is important when there's a lot of guys filling the airways with a lot of vitriol. The fundamental story, what's the silver lining behind cannabis? The fundamental story gets better and better and better and better. Just look at the earnings. Look at the revenue. You're seeing U.S. MSOs blow out earnings numbers, this constant grind higher in people using cannabis. It's just, these fundamentals are going to lead to big opportunity for investors if you manage your risk correctly. Okay? So let's look at MSOS. The ARMR report, if you guys were part of this back here, we bought MSOS right here, and we enjoyed almost all of this run, and we ended up selling it in here. Okay? We tried a couple trades in here as it tried to set up support right down here, and we made money. How did we do that? We bought right in here. It popped up. We raised our stop, broke down. We got out. We waited. We bought it right here, popped up, could not get above the 50-day, made a double top. We exited right there, made some money. Okay? So now it's breaking down, and it's at the bottom of this three line kind of rectangle. I don't know what that is really. I should take these off because it's going to make you think we should buy it here, and we really shouldn't. There's nothing. That is a nasty downtrend. There's no way to put lipstick on that pig. No way. There's nothing yet that would suggest I should be buying these stocks. And in fact, we saw US MSOs announce earnings last week, and all the stocks did was sell off. The earnings were fantastic, and the stocks are selling off. Why is that? I had a lively debate with some individuals on Twitter and whatnot, when I said that small cap stocks run as a group and cannabis companies in the US are the smallest of the small caps, okay? The people that own them, that's what obviously I'm not talking dollars. I'm saying the people that own them are retail investors, right? A lot of retail investors can't buy them. Institutions won't buy them. I mean, we have a liquidity vacuum. This is the difference between 2020 and 2021. The big indexes are grinding higher. Underneath the market is a hollowing out. You have phenomenal growth going on in an easy to understand business model in cannabis, and yet stocks keep going down because there's a hollowing out of the market and small cap stocks are breaking down. And these stocks lead that breakdown because of the nature of their business. Okay? So last week I said, well, let's look at, Village Farms. Maybe it was making a higher low. Well, that broke down, so that didn't work. I mean, we didn't buy it. There was no reason to buy it, and it broke down, right? Kronos. Oh, maybe it's setting up. Nope, no double bottom. It's just breaking down. Okay, this is a reality check, guys. You can't buy something just because you love the idea. You'll get buried in it, and then by the time it finally works, you'll be so worn out, you'll sell it right before it skyrockets. Okay? So you've got to manage your risk. There's no reason to own these names. But the silver lining in this situation, if you're an ARMR insider, if you're an ARMR report follower, is that you don't own a single share. And they're going to come right down into these price points that are just going to be a steal. Now, I'll tell you what I mean, and then I'll get to your questions. Okay? Look at CGC, Canopy Growth. I don't know if you remember this, but when Canopy Growth was doing this last year, we here at the ARMR Report were buying Canopy Growth leaps. Those are long-term options. We were buying it because Canopy leaps, which were more than 12 months of time value, were being sold to us with almost zero premium. I don't know, it could have been like 12 cents a premium. It was ridiculous. You could buy all that time for nothing. And that was the bottom in the whole group. Okay. So what we're looking for, and by the way, that was true, during this decline here. So we didn't buy it just because there was tiny premium, but we said, okay, now that we're at zero premium for 12 months on Canopy Growth, somewhere in here is going to be a reversal, and that's when we're going to start buying. So we saw the breakdown, reversal back up, and that's when we started buying those leaps. And of course, you can see it led to massive gains. So that will happen again if we're just patient. And we can be patient because we're not losing money. So when everyone else pukes them out and you get this reversal pattern, that's when we're going to hit them, and we're going to make a lot of money again at the ARMR Report. And I hope you guys join me. All right, let's get to the Q&A. What do you got for me? Let's start chatting. These conversations always go so long. I hope you enjoy them as much as I do. All right. Thanks for spending time with me today. Kevin, PLTR. All right. Let's rip through some charts. I love that pattern. I thought the earnings announcement was great. I think the stock could probably be bought. I love this part of the show, I think, more than anything else, because you guys give me some great ideas to focus on. But truth be told, Kevin, as an ARMR insider, you would be aware that this is all over our Slack room. We've been talking about Palantir for the last couple of days, and so we do have our eye on this position. We owned it here. It ran up. We booked a profit. It sold off. Now it had a decent earnings announcement back above the 200-day, and the standard 200-day is the gray line, and the exponential is the green line. So above all the moving averages we need. So that's a perfect idea to day trade, hop on a good day trade, and then hold it in the portfolio. Riot. I'm looking at Riot. I like the downtrend that was broken. You know, this is one massive, you know, pennant formation. And so what you want to do is see some type of a pattern develop on top of here. The only problem with this pattern, that I guess the reason why I never really get too aggressive in the stock, among other reasons, just a pure technical reason. Okay, this is a big pennant breakdown. There's a lot of people trapped up here at much higher prices. And so you don't expect a pure runaway at this stage in the crypto stocks. What you're looking for now is a base to form that's buyable. And so last week could have been the nice breakout. 1, 2, 3, 4, 5. So did it actually close down for the week? Well, it closed in the bottom part of its range, which is not bullish. So there's the weekly pattern on this stock. And they all look like this, more or less. So they put in these hammer tops, which is usually bearish. And that just tells me that there needs more time in the pattern. Let's look at Mara while we're at it. What the heck is that? That doesn't look right. I'll go to the daily chart here. Right? So Mara's got the same setup. Breakout, pull back on top of a base. A little bit different looking, obviously, than Riot. Okay. Mara looks a little bit better. But that looks like a stock that was down for the week, right? Yeah. So what looked like it should have been a really great week, what are the stocks telling you? And this is the key here to these crypto stocks for a second. So Bitcoin was up, you know, back to 46,000 or something. You know, Ether was running, and yet all of these stocks had negative reversal weeks. I would tell you, if this was the gold market, the price of gold would be going down next week, because the gold stocks break down first and then gold follows. I don't know if cryptocurrencies do that, but these stocks are telling you that something is not exactly kosher about the rally in crypto last week. So be advised. You know, some of the smaller names fared a little bit better. Hut looks pretty good. You know, no, Hive is kind of the same. They don't really intrigue me yet, and I really didn't like that reversal on Silvergate by the end of the day Friday. And again, my two favorite names are Silvergate, which is a negative hammer top right there, okay, for the week. And Coinbase is my other favorite. And there's just nothing about that chart pattern right there on Coinbase after earnings that gets me that excited. So wrapping that thought up, and I spent a little extra time here because I imagine you guys are going to ask me about it, so I'm just going over all these charts. I like Coinbase. It went right to the 200-day moving average on solid earnings, gap down the next day. I guess that was the gap down on earnings right here. So it just has work it has to do. And I think looking at those charts, I'm not too excited about crypto stocks right now. Great to day trade. Every day we should be trying to day trade them. Every day. You know, I'm going to just throw this out here. Some of the crypto stocks have chart patterns that look like that. See? Let's just draw this together. Whoops. Okay. So what you have is a chart pattern that looks just like that. I mean, that is almost identical to what happened to Riot, right? Pennant breakdown looks just like this. Rally back, fails, right? Tries to get up and implodes again. I don't care how great the story is. People keep telling me how great the fundamentals are. There's something wrong with Digital Turbine. I don't care how great the fundamentals are. That pattern's god awful. All right, moving on. Oh, Upstart is just one of my favorite names. I was not willing to buy it in front of earnings, and I'm disappointed in that. There's three names. KC. Kramer, quick kiss of death. Docs. Yeah. Look, I mean, Upstart. There's three names that I think are kind of I'm building a list, Kevin, of companies fundamentally that are disrupting their business dramatically. Upstart's one of them. SoFi is another, but SoFi broke down there, looks like, on earnings, right? I like RLGY, Realogy, which is completely changing, I think, the real estate business. So, I like those chart, bottom line, I'm not buying the stocks up here. If I owned them, I certainly wouldn't sell them. There's nothing wrong with them. They're on my whiteboard. I like them. That's all I can really offer you there. And well done for being on top of it. So see, Bit Digital, I mean, that's look at the weekly chart, guys. The weekly chart's telling you something's wrong with the cryptos, right? It should have had a huge week. It ended up down. So just, be careful on these names. Bitfarms actually looks better. And isn't that the one in Canada? The Canadian one, Bitfarms? All right. Good morning. MOS. Yeah. So, Mosaic. There's a bunch of industrial names that are really starting to take off. And here are some chart patterns that intrigue me. So this is a fertilizer company, okay? So we own shares of Dow Chemical and ARMR portfolios. It's a 4.5% yield, so we own some Dow Chemical. I look at Caterpillar, and I say, how do I not own the stock? I mean, Caterpillar looks phenomenal, and the Dow's breaking out. Deere looks even better. So you're talking about products, chemicals, things, of this nature. These groups are all going higher. Here's my only question for you, PM, and I ask myself this before I buy anything. What is the new? What new is going on that differentiates Mosaic? What's new? Is there something different, or is it just a group play because, you're getting a run in chemical stocks or phosphate or whatever, or fertilizers? If it's just a run in the group, that's okay. You can play it, but that might be a swing trade for me, right? If there's something new in the business, I'll give you an example on Deere. Okay. Deere took over Raven, RAVN. We talked about this, a couple months ago. It's bringing AI. It's bringing electronic vehicles. It's bringing AI. It's bringing robotics to the farming business. That's a whole new cycle for Deere. And I'm kind of sick that I don't own it. I should own Deere right in here. I mean, I should have owned it a long time ago, but I should own it right in here at the 50-day moving average, because there's a real new compelling story unfolding for Deere. So what's happening in MOS that's compelling? Maybe you can think about that and let us know. Sabre. All right. Do you see double bottom gold, silver? Nice to see you, Sabre. AEM. Let's look at these charts. All right. Let me just say this first, just in case you guys don't know. There was a massive takedown last week. Was it Sunday night? Well, I forget what night it was. Gold just imploded below 1700 for no apparent reason, and then reversed and ripped higher again. So I'm not going to go through all the conspiracy theories about manipulation. Let's just say that sometimes that action puts in a bottom. That's really all we care about, and that's the question you're asking, not about anything else. So could it be that you're getting a double bottom in Agnico Eagle? Absolutely. You want to look at AG? Maybe. You want to look at WPM? This is one of my all-time favorites. Absolutely. Now, you see, if I go to buy these names, I'm going to buy the leaders. So AEM and AG are trading near their lows. Wheaton Precious Metals is clearly making a higher low. So if I was to put any money to work in the space, I'd be buying wheat and precious metals. Okay, I'd say there's a double bottom at the 200-day moving average. It's in an uptrend. That's where the institutional support is. And you could buy it right here with a low really of a couple days ago. There's your stop. Breaks below the 200-day is never going to work, right? But if it holds there, double bottom, stays above 200-day, that could get interesting. And the other two names in the space that fit that bill are Royal Gold and Franco-Nevada. And what you'll notice about all three of those, Franco being the best, is that these are the royalty plays. Okay, so you really have limited political risk. They don't have big mines in a particular country that might steal all the gold. This is partially what's wrong with Newmont mining right now. Okay, and so if I was to do anything, I'd go in those three names, or I'd go with the index ETF itself. I guess I should move that because it broke down. So is it a shakeout? So Saber, before I buy these, I like to see some strength. I don't like to just buy a falling knife. So what I'd like to see is have it pop back up into this pattern, and then I would buy a little weakness, that tests and proves that the uptrend is intact. So we broke below the uptrend, get back above it, pull back and hold it, and then that's where you would see me get long on a higher low type of setup. That's what I would be doing. So I'm not buying anything yet. Hey, Tech. Hey, Deb. Oh, great. You're on Tech Monkey. You're on Altria with us. Excellent. Look, guys, I never know if I'm going to make money on an investment or not. Nobody does. Okay. I'm not out here, telling you I've got some crystal ball. But what I am telling you is I know how to set up the correct risk reward entry point. And if we do that over and over and over again, the net worth will follow. That's what we do here. Do you have a price target on PFE? My price target on Pfizer is the moon. That's my price target on Pfizer. My price target, pause, wait for effect, is the moon. Anybody know Despicable Me? I guess that would make you guys the minions. Anyway, here's what I do, Saber, with an investment like this. First of all, I bought it. We all bought it down here at the ARMR report to collect a 4% yield. Okay. So number one, I'm collecting a 4% yield and my principal's going through the roof. I may never sell it. Okay. That's an exaggeration. I'll have a very lenient, long-term, okay, stop loss, right? So at some point, stock's up enough. Here's how I do it. The stock's up enough, and I'm going to collect 4% yield. So my stop is going to be above break even at this point. And I'm going to want to take some money off the table for for the effort that I'm making, right? Get paid for your work. So you raise your stop loss up a little bit more and say, okay, if it comes down here, at the very least, I make some money and I collected some yield. But for me, an idea like Pfizer is a long-term hold in a portfolio if it keeps going up. I'm not looking to trade it. This is the greatest of all possible situations. I can collect 4% in a dividend and have the stock go up. I mean, I'm done. I mean, I'm going to hold on to that thing. So it's not a type of stock where I say it's 4 standard deviations above the 200-day, I should be selling it. Now, I'm not saying you can't pare back your position. If it gets to be too big of a position size for your whole portfolio, you can bring it back down. I don't know. Let's say you put a 10% position on at the beginning, and all of a sudden the thing becomes, let's say it goes up 50%, whatever, and now it's 15% of your portfolio. All right, pare it back down. Maybe it's 12% of the portfolio. Pare it back down to 10. Right? So I might shave the position down at these lofty levels just to bring it back to an average position size. But at the end of the day, I don't really want to sell it. I want to collect that yield. The other thing we could do, and we'll talk about in the live trading desk, and we'll talk about in the Slack room, and I'll share it with ARMR insiders, ARMR original insiders. We'll share it in our daily emails. There are days when you can go out there and write calls It's the most conservative call strategy out there, right? You can increase your yield. So when this thing rips higher like this, and you could go write a call a month from now and collect time premium, okay? If the stock gets called away from you, okay, so be it. You book a huge profit and you had a little bit extra yield, whatever. But if the stock pulls back, right, and comes back down to a moving average, you get to collect all that premium to put it alongside your yield, just enhancing your yield. And every time the stock skyrockets, you sell calls again. Look, eventually someone might call the shares away from you. Okay, so be it. But if you do it right, man, you could write calls 2 or 3 times during the year and increase your 4% yield and still have the stock in your portfolio. So I'm looking at Pfizer differently than these other stocks that I'm trading. Morning, Brett. Oh, well done. Well done, Stephen. Glad you had a positive week. And I just keep not trading, these steel stocks, and they keep going, through the moon. So, I mean, I day trade them, but I'm not holding steel stocks. Cliffs and U.S. Steel, I thought, were the best ideas fundamentally because of the changes they made last year. But clearly, the best stocks to own right now are Nucor and Steel Dynamics. But long term, I think Cliffs is a phenomenal idea. Okay, and if you own it down in here and the stock is running, and let it go. I mean, raise your stop maybe to the 25-day moving average is what I would do, or maybe the 50, depending on how much room you want to let it wiggle. And if you look at the leaders in the space, I mean, they're just skyrocketing again. I mean, shame on me that I don't own Nucor at the 50. I mean, just shame on me. Steel Dynamics, I mean, at the 50-day moving average, that was just a no-brainer. So if you're on it, well done, and I wouldn't let it go, and I just raise my stops. What are your Oh, you're welcome, Stephen. I'm so glad I could help you stay out of both. It's the truth. I like precious metals and I like cannabis, but I like my own capital more. I like my net worth more. I don't hold anything just because I like it. All right. Right. Hey, Nuke Lelouch. I love it. IEP. Icon Entertainment. No. I have to do some work there. Don't have any anything to give you. What's the yield there? Is there a yield play? Let's take a look. Oh, it's a 13.7% yield. Okay. So those are probably special dividends, right? I don't know. If you like Carl Icahn and you think that dividend's for real, then there's certainly nothing wrong with it. But this isn't really a dividend stock to me. When I buy a dividend stock, I'm trying to buy something that will reduce the volatility in my account, not increase the volatility in my account. And I think that the appropriate yield right now, risk-adjusted yield on a dividend play, is anywhere between 3 and 5%. If you catch something at 7 or 8%, you better do a lot of research on it. Okay, I'm comfortable with Altria. I'm comfortable to a certain extent with LUMN Tech, but those are reaching for yield. The real sweet spot to me is 4 to 5%. Those are real dividends, I think, that are legitimate, that aren't in jeopardy of being cut or anything like that. And there's some of these companies out there that have 13% yields, 10% plus yields. Check to make sure they're not special dividends, so you don't really know what the yield will be this year. It depends on what the dividend declaration will be. So you'd have to do a lot of work on Icon before I would buy that stock. COPX. Miners, hey, they look pretty good. Huh. COPX, put that down. And so it must be FCX must look pretty good. Yeah, that doesn't look bad. And like tech is, my favorite in that space. Tech resources. That looks pretty good. That looks really good to me. And maybe they're going to follow steel. So maybe we should be definitely, at the very least, day trading these names next week. I haven't the slightest idea, Saber, about your portfolio, so I can't answer that question. I don't know if you bought it before the ex-dividend date, the dividend will show up in your account. It doesn't necessarily show up in your account the very next day. So I don't know. I don't know the answer to that question. And I haven't looked. If you bought it before the ex-dividend day, you'll get paid. But it might hit your account in a couple of weeks. It doesn't always hit it immediately. Does it really? Jersey Devil, does it really? You grow? You think so? I don't know, man. I had a one-on-one with management before the company went public. And so I had a chance to chat with them directly. And I just don't like the business model. But certainly the chart pattern looks good. But I don't see how we're going to make money in that stock, brother, without, MSOS going up. And look at what they just did to GrowGen for missing the number. I mean, holy smokes. It's a good thing we're not sitting in GrowGen. They missed the number. They killed it. So I think before UGrow ever goes up, we have to see. Remind me about UGrow when MSOS is breaking out to the upside. Because I guarantee UGrow is not going to lead that. And it might be a good scoop up after we already start making money elsewhere. And we say, what else should we be buying in the cannabis space? And it's a Saturday and Jersey Devil says to us, oh, don't forget UGrow. Oh, yeah, it's perfect. Like that's kind of when we're going to want to buy UGrow, in my opinion. Good morning. Oh, geez, man. Erez, how are you, brother? When to buy skin? Oh, geez. I'm just. It had to be bought before earnings, obviously. And I wasn't willing to put money to work in a company before earnings that's small cap in nature with small cap index not looking good to me. So sometimes I miss things and I have it on my radar. And, I work with a couple estheticians and they own the stock. We talked about it back in here and we just bought the stock because they're convinced this is the greatest idea ever. And boy, do they look right now. So I don't know, man. We're going to have to find our way in there and I can't chase it now. Yeah. I literally bought some Novaks right at the close and then I thought about it and I said, what am I doing here? I don't want to buy this over the weekend. But at some point, first of all, that chart's great. That looks great to me. I think the stock's going to skyrocket. I wish I owned it right now. This is at the top of my list to day trade tomorrow morning. I'd like to get this stock on weakness at the open somewhere down near the VWAP, which is the black dotted lines. Gives us a risk on entry point. I want to own it. I think then Novavax is going up a lot. For those of you who don't know the Novavax story, real quick, Pfizer, Moderna, these are mRNA products. They've got the lead, that they're the vaccines. But by the way, these stories are not just COVID stories. They can use these technologies for flu vaccines and make them so much more effective than the vaccines out there. There's all kinds of different ways. This is a huge story. This is why I'm not looking to sell Pfizer anytime soon. Okay. So NVAX is a different way to do the vaccine using proteins. It seems to be very effective. It has different or less side effects. Let me rephrase it. Let me take that back. I don't care if it has different or less side effects. That doesn't put the stock up or down because there's going to be room for mRNA and a protein vaccine product. There's going to be room for both. Some people can't do the mRNA. They'll do protein, whatever. Countries like India, Indonesia, the Philippines, they don't have any vaccine. They can't get their hands on any of the mRNA products. Okay. And so if it appears like it does, that the Novavax protein product, the side effects are manageable and it's effective, I think we're going to see in the near future approvals for emergency use in those countries. And I think when that happens, the stock goes berserk. So I'd like to try to be on it. Yeah. Yeah. I don't disagree. I don't disagree. So anyway, guys, look, and this has been lots of fun. I appreciate you guys spending time with me. Any questions last second that you've got, I'd be happy to answer. If not, and we're all good, then I wish you a wonderful afternoon. And while you're just thinking, in case there's another question out there, if I were to order, you know, some of the names at the top of my whiteboard, yeah, I guess we've already gone over it. Is there anything I'm missing? How about DraftKings? Boy, it's starting to look compelling again. Double bottom right at the 200-day moving averages. So there's a reasonable stop setup that I like. And that's starting to look interesting to me again. Look, it looks like Penn broke down though, huh? Not quite, not quite. Penn's doing the same thing. If it can get above this area right in here, and you can use a stop like right in here, that's a nice tight stop. So Penn and DraftKings will be at the top of my list to day trade as well, and see if I can work my way into a position. Four. Now 4 is breaking down out of a pennant, so there's nothing for me to do there. I like this idea, but nothing doing there. All right, guys, listen. This was a pleasure. I look forward to seeing you all again next week. Have a great trading week. Those of you who are joining me on the live trading desk or in the ARMR Slack room, don't forget, guys, you know, you can always subscribe and join us, become an ARMR Insider, and we can share all these thoughts all day long. All right? Take care, everybody. Have a great day.